Within this video, we're going to be looking at Unit 2, Topic 3, which is all about borrowing products. So, as part of this video, we're going to cover mortgages and what they are. We're going to look at a number of different mortgage key terms. We're going to assess the home buying process and look into loan forbearance. We're going to then cover government home ownership schemes and look into other types of borrowing such as personal contract purchases and hire purchase. So, mortgages, what are they? Well, mortgages are borrowing products where an individual borrows money from a lender in order to buy an asset, usually property or land. This is usually for a long period, for up to 40 years. The borrower pays it back in monthly instalments. Now, technically, the mortgage is actually the security deed itself, but the word is now used to refer to the loan itself. So some key points: they're borrowing products and usually used to buy property, land, buildings. This is usually for a long period of time, and in fact in the UK we can get mortgages up to 40-year terms, depending upon our age, and the borrower will repay it back in monthly instalments. So, we have a number of mortgage key terms we need to be aware of, so I'm going to go through each of these now. The first one is the mortgage term, and this is the amount of time that the mortgage is taken out over. We mentioned earlier that these in the UK are up to 40 years, but generally if you take out a mortgage, say at 40 years old, you only have 26 years until the retirement age, and therefore the maximum amount of time that the bank or building society is likely to give you of a mortgage term is going to be 26 years. The first-time buyers are people who have not bought a house before or not taken out a mortgage before. Residential mortgages. These types of mortgages are used in order to buy a home in which we are planning on living in. Buy-to-let mortgages, on the flip side, are mortgages used to buy property that we intend to rent out to tenants. The interest payable on a buy-to-let mortgage is generally higher than a residential mortgage. Equity is the amount of the actual home that we own ourselves. So, for example, if we put a 25% deposit down on a home, we will, until we've paid off the mortgage at least, we will own 25% of that house, or we'll have 25% equity within it. Negative equity is where we may put, say, a 10% deposit down on a £100,000 house, which means that we have put £10,000 in. Of course, if that house actually goes down in value, say to £50,000, we will actually have negative equity. We will owe still £90,000 to the bank, but and the house will only be worth £50,000. That means we've actually got negative equity, i.e. we owe more back to the bank than a house is actually worth. A fixed rate mortgage is one whereby the rate or the interest rate we pay is fixed. These are generally for a specific amount of time. It might be 2, 3, 5, 10 years or even more these days. Loan to income. This is where the loan we're able to get is generally a multiple of the income we are on. So, for example, if an individual is on £50,000 income per year, the lender may offer them a loan to income or a mortgage of 5 times their income. So in that case, it may be 5 times 50,000 will be 250,000. That would be the amount they are willing to loan or lend to that individual. The loan to value ratio is the amount a bank or building society is willing to loan to you compared to the value of the property. So if they are willing to lend 80% of a property's value, then if you bought a £250,000 property, then they would be willing to lend you £200,000. Interest-only mortgages are those types of mortgages where we only pay interest back to the lender. We don't actually pay back any of the initial amount borrowed. Repayment mortgages, on the other hand, are where we repay interest, of course, but we also repay the initial amount borrowed. The difference between those two is at the end of the mortgage term, with an interest-only mortgage, you will still owe the bank the initial amount borrowed, whereas with a repayment mortgage, you will have paid off both the initial amount borrowed, as well as the interest over the mortgage term. The term security, when it comes to mortgages, means the house or building, property, land acts as security for the loan. So if the bank or building society is unable to get their loan back, i.e. the borrower does not pay their loan back, then the bank or building society is within their rights to seize that underlying asset or the security, whether it be, as mentioned, a building, a property, land, etc. So they can then seize that asset, that security, and sell it off in order to recover money owed to them. Repossession is the process of recovering that underlying asset, of recovering or repossessing that house, building, bit of land, for example. A tracker mortgage is one where the interest rate tracks a specific interest rate. So it might be the base rate, which is of course set by the Bank of England's Monetary Policy Committee, plus maybe 2 or 3%. And that rate will of course track that base rate, and that means if the Bank of England base rate increases, which it has done recently, then someone with a tracker mortgage would pay more back in interest to the bank or building society. Offset mortgages are quite a unique type of mortgage and are not offered by all lenders. This is where an individual will have a mortgage account but also a savings account with a particular lender. The reason why it's called an offset mortgage is if that particular borrower has money in their savings account, the mortgage organisation, the lender, will actually charge them less interest than if they did not have any money in their savings account. So essentially offsetting the cost of your interest if you have money within a savings account with the same provider. Stamp duty is when we buy a property or building, land, we have to pay a specific amount of that purchase price to the government in the form of a tax. And we're going to have a look at stamp duty in a bit more depth. So you can see the stamp duty rates from 23rd of September 2022 in this table. If you'd bought a property up to £250,000, the stamp duty land tax rate, or SDLT rate, would actually be 0%, so you wouldn't have to pay any stamp duty to the government. However, if you bought a property over £250,000, you'd have to pay a portion of that property's value to the government in the form of stamp duty. So, for example, if you bought a house worth £500,000, the portion between £250,001 and £500,000, you'd have to pay 5% of that value to the government on completion, or within 28 days of completion, in stamp duty. So this effectively increases the more expensive your house is, and therefore you have to consider this when purchasing a property. So what is the home buying or purchasing process? Well, firstly, it's important to set a budget. We can work out what our budget is based upon what savings we have or what the value of investments are. Then we can approach a lender and get something called a mortgage in principle. This is when a lender will agree to lend a specific amount and will put down on paper, we agree to lend this individual this specific amount. With this mortgage in principle, we can then go and view properties. We can view houses or land or buildings that we like and would like to purchase. Once we find one that we like, we can make an offer to the seller of that property. If they agree to the offer and they are willing to make a trade, then we can instruct a solicitor. and this is an individual who specialises in something called conveyancing or housing law, and they will take us through the rest of the process. They will organise searches and surveys. These are when specialists in their field will search the property and they'll check whether there are things like any mine shafts underneath the property, for example. Of course, if there is a history of mining in the area, houses and property is potentially susceptible to subsidence. They will also carry out surveys of the property, and in order to do this, they might hire a surveyor. This surveyor will check that the roof is in good condition, that there is no subsidence, that the boiler is working, essentially checking that the house is in good working order. And they'll provide a survey report to the buyer to see if they still want to go ahead with the purchase based upon the condition that the property is now in. If we are happy with the property, the surveys and the searches, then we can exchange contracts. And our solicitor will check these contracts very carefully to ensure that there are things like there are no outstanding loans on the property that we are not already aware of. And based upon that, after we've exchanged contracts, we can start booking removals and preparing for the exchange of contracts. Once we've booked our removals in, we can start packing our belongings at our current house if we're moving, and then we can get ready for completion date. This is where we send our money, which will be already held by the solicitor, and of course then we get the keys and we can move into the property itself. So once we've moved into the property, we'll begin to pay our mortgage, and hopefully we'll be able to pay back our lender in monthly instalments without any issues. However, the next thing we're going to look at is something called loan forbearance. The term forbearance refers to the temporary postponement, this is from investopedia.com, of loan payments, typically for a mortgage or a student loan. Lenders and other creditors grant forbearance as an alternative to forcing a property into foreclosure or leaving the borrower to default on the loan. So, as we mentioned earlier, hopefully we're able to pay our mortgage, but if we are unable to pay our mortgage, then, well, essentially, the lender has the right to force the property into something called foreclosure, essentially starting the process of repossessing that property. Of course, ideally, they don't want to have to go down that route. They want the borrower to be able to pay back the amount owing. And therefore, this is where loan forbearance comes in. Essentially, the lender is offering the borrower the opportunity to temporarily postpone loan repayments, in this case for a mortgage. This would mean that the mortgagee, the person who has taken out the mortgage, has a bit of time to get their finances together in order to then resume making repayments. This service is not provided for free, and the mortgagee will have to repay any money which is outstanding, of course. But nonetheless, it is an option that lenders have in order to avoid forcing a property into foreclosure. The government help to buy schemes. What are they and who are they for? Well, these are for first-time buyers and home movers who wish to move into new builds with a value up to £600,000. What are they then? Well, the buyer provides a 5% deposit. The mortgage company will put up 75%, and the government will put up 20%. The 20% is called an equity loan, and the buyer has the power and the choice to sell at any time, and they pay some or all of the equity loan off at any time without selling the property. The buyer can pay the equity loan off also at the end of the term. But is there anything else I should know? Well, the government will pay up to 40% for London properties. Why did the government bring this Help to Buy scheme in? They were finding that many first-time buyers were unable to get onto the property ladder because of the large deposits required by many mortgage or lending companies. This meant that the government, in order to get those first-time buyers a property of their own, were willing to put 20% of the value of that property in place to the borrower. This meant that the borrower could go to a mortgage company with a 25% deposit effectively, rather than just a 5% deposit. This meant that the mortgage company would be much more willing to deal with those types of individuals. Of course, once again, the government did not provide that for free. They provided, I believe it was 5 years of interest-free borrowing, but then if the borrower had not paid that 20% government equity loan off after 5 years, then they would start charging interest on it, essentially meaning that the buyer had a mortgage and a equity loan to repay. Other borrowing options include personal contract purchases and hire purchase. A personal contract purchase, or PCP for short, is like a long-term rental. It allows you to use the item, for example a car, until the contract ends. At the end of the contract, a PCP holder has two options. They can either return the asset, the car in this case, or they can pay the resale value of the car and then they get to keep it. This is very attractive to many people who would like to buy, or in this case, rent a new car, but they do not have the upfront money in order to purchase it. An alternative is hire purchase. Now, this enables a customer to acquire an asset by paying an initial installment, 40% of the car's cost, for example, and then repaying the outstanding balance over the term of the contract. These hire purchase agreements are regulated by the Consumer Rights Act. So, let's test our understanding of Unit 2, Topic 3 with some multiple choice questions. The first question is, when borrowing money to buy a property, the ratio of the money borrowed to what the property is worth is known as the A. Annual equivalent rate, B. Annual percentage rate, C. Loan to income, or D. Loan to value. The answer to question 1 is D. It is known as the LTV, or loan to value. Question 2. Hire purchase agreements are regulated by the A. Consumer Rights Act, B. Financial Services Act, C. Financial Services and Markets Act, or D. Trade Descriptions Act. The answer to question 2 is A. A hire purchase agreement is a form of credit and is regulated by the Consumer Rights Act. Before we go on to question 3, remember I have done a full video about 3 specimen papers worth of multiple choice questions. I urge you to check it out in advance of your multiple choice assessment. I've also done other Unit 2 knowledge blasts, and I'll leave the link to all of them within the description. So question 3. The personal contract purchase method of borrowing is typically used by people buying A. Holidays, B. Motor vehicles, C. Properties, or D. Stocks and shares. Whenever we are looking at a particular multiple choice question, we're unsure of the answer, it's worth crossing off those which we definitely know it will not be. So if, for example, we think that the PCP method of borrowing is not typically used to buy stocks and shares, we'd cross that one off, and that will leave us with less potential options. Nevertheless, the answer to question 3 is B. Personal contract purchases, or PCP for short, are normally used to buy cars, motorbikes, or other motor vehicles.